With me, I've got Capital Network's Ed Stacey on Skype. Ed, good morning.
Good morning.
We're talking Custodian REIT. Of course, they've had a quarterly valuation announcement out. You've written a report. How's progress for them? How are they coming along?
Well, our thinking is that in the current volatile market, investors should be looking for investments that give you a good deal of downside protection. Custodian is yielding 5.4% annual dividend yield, so it's a great income investment. But we also argue it's one of the safest dividends in the REIT sector, real estate investment trusts. So yes, as you say, the company has published its quarterly valuation update this week, and that shows that strong progress continues, and we're still confident in that dividend.
You say they've got one of the safest dividend yields around. What is it in particular that makes this dividend safe?
We wrote a lot about this in our initiation report back in May, and that is still online. So a good thing for people to have a look at if you want a bit more detail about these safety sort of measures. But essentially, good diversity in the portfolio. So it's non-residential properties that is spread around the UK regions and spread across office, retail, and industrial distribution. So good diversity there. Also low balance sheet leverage. It's a 20% loan to value ratio approximately. So that's about 20% mortgage on their properties effectively. That's a low degree of financial risk. And then finally, if you look at the recent acquisitions, so this is again in the quarterly report, they list the acquisitions they've made during the quarter, giving rental yields of between around 6.5% and 9.5%. So excellent rental yields they're getting on their investments, but also long lease terms. They're buying properties with sitting tenants with long leases in place. So all of these measures reducing that risk profile.
We've had a bit of news recently around these CVAs, the customer voluntary agreements. Of course, when a retailer gets a reduction in rent, it's been a bit of a negative for some landlords in the sector. How's it impacted Custodian?
Yeah, so Custodian does have retail properties. And in fact, in this latest report, they reference the fact that they are exposed to office outlet who have a CVA agreement. But when you look at what's happened during the 3 months, Custodian has still delivered a net asset value return of 2.3%. That's just for the quarter. So net asset value returns are a technical term, but what does that mean in terms of the actual share price and the dividend? Well, the shares have been dead steady and the dividend very much remains intact. So yes, it's been a quarter where for some in the retail sector, the stuff has hit the fan, so to speak, but it's bounced right off for Custodian, and it just shows these risk mitigation measures really do work.
Just finally, Ed, on the spectrum of, say, low risk at one end, returns on the other, where would you place Custodian?
I would say Custodian is delivering on both counts. That yield of 5.4% is a great dividend yield, but plus you get capital gains. Typically, the net asset value ticks up in terms in line with rent escalations. So you end up with a sort of through cycle return on Custodian of 8%. So it's a strong return, a very good return. So yes, it's a safe investment, but actually it's giving you great returns as well. So I think a little bit of having your cake and eat it, in fact.
For Ed's full report, click on the I in the top right-hand corner of your screen. Ed, thanks very much.
Thank you.